Ladies and gentlemen, esteemed colleagues and fellow thinkers, thank you for joining me today. As we gather in these turbulent times, I can't help but pose a stark question that cuts to the heart of our global economic reality. What happens when the world's largest holder of U.S. debt decides it's had enough? Imagine a house of cards built on borrowed promises, teetering under the weight of its own contradictions. This is the American economy in 2025, and China's recent moves are pulling out the foundational supports. Today, I want to delve into the seismic shifts we're witnessing: China's systematic dumping of U.S. Treasury bonds, the ensuing collapse of the dollar's value, and the palpable panic gripping former President Trump and his allies. These events aren't mere market fluctuations, they signal the unraveling of an empire built on capitalist overreach. Let me start with the facts, because in economics, as in life, we must ground our analysis in material reality. Over the past year, China has accelerated its divestment from U.S. Treasuries, reducing its holdings to a 16-year low by April 2025, with sales amounting to billions, $8.2 billion in that month alone, according to U.S. Treasury data. This isn't a whim, it's a calculated response to escalating U.S. tariffs imposed under the Trump administration's aggressive trade policies. Think about it: for decades, China has been the banker to America's spender, accumulating over $759 billion in U.S. debt to fuel its own growth, while propping up the dollar's status as the world's reserve currency. But now, amid a trade war that shows no signs of abating, Beijing is saying, "No more." By dumping these bonds, China is not just liquidating assets, it's weaponizing its economic leverage, forcing Treasury yields to spike and eroding confidence in U.S. financial stability. And here's a hook that should make every American pause: if China fully unleashes its nuclear option, as some analysts call it, what prevents a cascade that could devalue the dollar by another 10% or more, as we've already seen in the first half of this year? The dollar's collapse is no exaggeration, it's unfolding before our eyes. We've witnessed the greenback slump by over 10% in 2025, marking its worst first-half performance since 1973, driven by unfunded U.S. policies, mounting debt, and this very bond sell-off. From a Marxist perspective, this is the inevitable contradiction of capitalism. A system that relies on endless expansion and exploitation now faces a rival that has outmaneuvered it. The U.S. has printed trillions to sustain its dominance, but as central banks worldwide shift toward gold and alternatives like the BRICS initiatives, the dollar's hegemony erodes. Predictions abound of further declines, with some experts warning of a dollar apocalypse, where gold surges to $5 an ounce as faith in U.S. paper wanes. Ask yourself this provocative question: how long can an empire borrow its way to power when its creditors start calling the shots? And then there's the panic in the Trump camp, a telling symptom of this deeper crisis. Reports paint a picture of alarm as bond yields soar and stock markets waver in response to China's actions, with Trump himself accusing Beijing of conspiring against the U.S. His tariffs, meant to make America great, have backfired spectacularly, prompting retaliatory bond dumps that threaten the very financial system he champions. This isn't strength, it's desperation. Trump and his advisors are scrambling, even floating ideas of reversing high China tariffs to stem the bleed. But here's the real hook: in this dance of economic warfare, the U.S. is the one losing its footing, revealing the fragility of a capitalist order that prioritizes profit over people. China's state-directed economy, by contrast, allows it to pivot strategically, underscoring why the U.S. is a declining empire while China ascends. In closing, my friends, these developments compel us to rethink the foundations of our economic system. China's bond dump and the dollar's plunge aren't isolated incidents, they're harbingers of a multipolar world where U.S. imperialism can no longer dictate terms. As we face this reality, let us not despair but organize toward worker cooperatives, democratic planning, and an end to exploitation. The empire is crumbling, the future belongs to those who build anew. Thank you. China's calculated reduction of its U.S. Treasury holdings in 2025 represents a seismic shift in global economic dynamics, a move that reverberates far beyond the bond markets and into the heart of U.S. financial stability. Official U.S. Treasury data reveals that China, long a cornerstone of America's debt-fueled growth, has slashed its holdings to a 16-year low, with a notable $8.2 billion sold in April 2025 alone. This isn't a mere portfolio adjustment, it's a strategic maneuver, a direct counterpunch to the Trump administration's escalating trade war, which has seen tariffs on Chinese goods soar to 145%. But here's a question that should jolt every observer. What happens when the world's second largest economy decides it no longer wants to bankroll the first? China's actions are not just about economics. They're a geopolitical power play, signaling a profound challenge to the U.S.-centric financial order that has dominated for decades. For years, China has been the silent financier of America's profligate spending, amassing over $759 billion in U.S. Treasuries by December 2024 to stabilize its own currency and fuel its export-driven growth. This symbiotic relationship allowed the U.S. to borrow cheaply while China accumulated safe, dollar-denominated assets. But the rules of the game have changed. The Trump administration's aggressive trade policies, including Liberation Day tariffs announced in April 2025, have pushed Beijing to retaliate not with tariffs alone but with a far more potent weapon: divestment from U.S. debt. By offloading billions in treasuries, China is deliberately driving up U.S. borrowing costs as bond prices fall and yields spike. 10-year Treasury yields hit 4.5% in April, a level not seen since the post-pandemic volatility. Imagine this: every percentage point rise in yields adds billions to the U.S. government's interest payments, squeezing budgets already strained by a $36.22 trillion national debt. Can America afford to keep borrowing when its biggest creditor is walking away? This strategic bond dump is not a reckless fire sale, it's a calculated escalation in a financial Cold War. China's sales are measured, avoiding a catastrophic market collapse that would harm its own portfolio, but they are significant enough to send a clear message. Beijing is no longer willing to prop up the dollar's hegemony. Analysts warn that a full-scale liquidation, China's so-called nuclear option, could depress Treasury prices further, potentially increasing long-term yields by 30 to 60 basis points, a move that would ripple through mortgages, car loans, and corporate borrowing. Here's a hook to ponder. If China continues this trajectory, could it force the U.S. Federal Reserve to intervene, printing even more dollars and risking hyperinflation? The stakes are staggering, as China's actions expose the fragility of a U.S. economy built on the assumption of endless foreign demand for its debt. Moreover, this move aligns with China's broader strategy to reduce reliance on the U.S. dollar. As part of the BRICS coalition, China is diversifying its reserves, increasing gold holdings, and promoting the Yuan in global trade. This isn't just about economics, it's about sovereignty. By shedding treasuries, China is asserting its independence from a financial system that has long favored Washington. The April 2025 sell-off, combined with similar actions by other BRICS nations, signals a collective push toward a multipolar world where the dollar's dominance is no longer guaranteed. For American policymakers, this is a wake-up call. The era of unchecked borrowing is ending, and China's strategic retreat from U.S. debt is rewriting the rules of global finance, one bond sale at a time. The U.S. dollar's precipitous decline in 2025, plummeting over 10% in the first half of the year, marks a historic unraveling, the worst since the collapse of the Bretton Woods system in 1973. This is not a fleeting dip but a profound signal of eroding global confidence in the greenback, driven by China's aggressive sell-off of U.S. treasuries and a broader shift toward alternative assets. Picture this: the currency that underpins 54% of global exports and nearly 70% of international bonds is losing its grip, shaking the foundations of U.S. economic dominance. What happens when the world's reserve currency, long a symbol of American might, becomes a liability? The dollar's slide, fueled by a toxic mix of unfunded U.S. policies, spiraling national debt, and geopolitical missteps, exposes the fragility of a system built on borrowed time. China's divestment from U.S. treasuries, slashing holdings by billions to a 16-year low of $759 billion by December 2024, has sent shockwaves through financial markets. These sales, a direct response to Trump's tariff escalations, have driven Treasury yields to 4.5%, undermining the dollar's perceived safety as a safe haven asset. As bond prices fall, the cost of U.S. borrowing soars, exacerbating a national debt that stands at a staggering $36.22 trillion. But here's a gripping hook: if global investors, spooked by this volatility, accelerate their flight from dollar-based assets, could we see the dollar lose another 10% by 2026, pushing inflation to levels unseen since the 1980s? The data is stark. Foreign ownership of U.S. Treasuries has dropped to 30% from a peak of over 50% during the global financial crisis, signaling a broader retreat from dollar-denominated investments. The global pivot away from the dollar is gaining momentum, with central banks, led by China, Russia, and other BRICS nations, stockpiling gold at unprecedented rates. China's gold reserves, now at 235 tons by late 2023, reflect a strategic shift to hedge against dollar volatility, with gold's share in its reserves rising to 4.9%, the highest since 2015. This isn't just diversification, it's a deliberate challenge to the dollar's hegemony. Forecasts suggest gold could climb to $5,000 an ounce by mid-2026, a stark indicator of waning faith in U.S. paper. Ask yourself this: when nations like India and Brazil start settling trade in yuan or local currencies, what's left to prop up the dollar's global dominance? The transactional dominance of the greenback, once commanding 88% of foreign exchange volumes, is eroding as China's yuan rises to 56% of its cross-border trade, up from 20% a decade ago. From a Marxist lens, this collapse lays bare capitalism's contradictions. A system addicted to debt-fueled growth now faces the consequences of its excesses. The U.S. has printed trillions to sustain its empire, but as confidence wanes, the dollar's slide threatens to spiral into a broader economic crisis. Trump's policies, particularly tariffs as high as 145% on Chinese goods, have accelerated this decline, prompting retaliatory moves that expose America's vulnerability. The dollar's 10.8% drop against a basket of major currencies in 2025, coupled with a surge in demand for euros and European bonds, underscores a world rethinking its reliance on U.S. financial leadership. This is no mere market correction. It's a historic turning point where the dollar's fall signals the twilight of an empire and the rise of a multipolar economic order. The surge in U.S. Treasury yields, with the 10-year note reaching 4.5% in April 2025, marks a critical inflection point in the American economic narrative, driven by China's calculated sell-off of U.S. debt and a growing crisis of confidence among global investors. This sharp spike, up from 0.08% earlier in the year, reflects a market reeling from the reality that the world's second largest economy is no longer willing to bankroll America's deficits. As China unloaded $8.2 billion in treasuries in April alone, reducing its holdings to a 16-year low of $759 billion, bond prices plummeted, pushing yields to levels not seen since the volatile post-COVID recovery. Here's a question to grip your attention: what happens when the bedrock of global finance, U.S. Treasuries, once deemed the ultimate safe haven asset, becomes a risky bet? This yield surge is not just a number. It's a warning siren of a financial system under strain, with implications that ripple from Wall Street to Main Street. The mechanics are straightforward yet brutal. When China and other foreign investors sell treasuries, supply floods the market, depressing bond prices and driving yields higher. Each percentage point increase adds billions to the U.S. government's borrowing costs, with the national debt already ballooning to $36.22 trillion. This spike in the 10-year yield, a benchmark for mortgages, corporate loans, and consumer debt, threatens to choke economic growth. Mortgage rates, now hovering near 7%, are pricing out home buyers, while corporations face steeper costs for capital investments, stifling expansion. But here's a provocative hook: if yields climb another 50 basis points, as some analysts predict, could we see a wave of defaults in the corporate bond market? Echoing the chaos of 2008, the data is sobering. Foreign ownership of U.S. debt has fallen to 30% from over 50% a decade ago, signaling a profound shift in global trust. This yield surge also reflects deeper market anxieties, amplified by the Trump administration's trade policies. Tariffs as high as 145% on Chinese goods have triggered Beijing's retaliatory bond dumps, creating a vicious cycle of rising yields and market volatility. The 30-year Treasury yield, climbing to 4.977% in September 2025, underscores fears that long-term U.S. debt is increasingly seen as a gamble, not a guarantee. Investors are demanding higher returns to compensate for risks tied to ballooning deficits, political gridlock, and a potential downgrade in U.S. creditworthiness. As Moody's warned in 2025, from a Marxist perspective, this is capitalism's contradiction laid bare. A system reliant on perpetual borrowing now faces creditors who doubt its solvency. Ask yourself this: if global markets start pricing U.S. debt like a corporate bond rather than a risk-free asset, how much more will taxpayers have to shell out to service the debt? The broader implications are chilling. Rising yields threaten to unravel the delicate balance of U.S. fiscal policy, forcing the Federal Reserve into a corner: either raise rates to stabilize the dollar, risking recession, or keep printing money, fueling inflation. China's strategic pivot, coupled with BRICS nations' shift toward gold and alternative currencies, is eroding the dollar's dominance, which in turn undermines demand for treasuries. As yields climb, the cost of servicing America's debt, already projected at $1.7 trillion annually by 2030, could spiral further, squeezing budgets for social programs and infrastructure. This is more than a market event. It's a geopolitical reckoning, exposing the fragility of an empire built on borrowed promises, now facing a world that's no longer buying. The Trump administration's aggressive trade policies, particularly the imposition of tariffs as high as 145% on Chinese goods in 2025, have ignited a financial firestorm, prompting China to retaliate with a calculated sell off of U.S. Treasury bonds that has sent shockwaves through global markets. Former President Donald Trump's strategy, framed as a bid to restore American economic dominance, has instead exposed the vulnerabilities of a debt-dependent U.S. economy, with reports of palpable panic among his advisors as Treasury yields spike to 4.5% and the dollar plummets by over 10% this year. Picture this: a policy meant to make America great, unraveling into a self-inflicted wound, with China's bond dumps driving up U.S. borrowing costs and destabilizing the very markets Trump claims to champion. How can a leader who promised economic strength now find himself scrambling to contain a crisis of his own making? The roots of this debacle lie in Trump's tariff escalation, branded as Liberation Day, in April 2025, which hiked duties on Chinese imports to unprecedented levels. Intended to pressure Beijing and boost domestic manufacturing, these tariffs instead provoked a fierce response. China sold $8.2 billion in treasuries that month alone, reducing its holdings to a 16-year low of $759 billion. This strategic divestment has pushed bond prices down and yields up, increasing the cost of servicing America's $36.22 trillion national debt. The market turmoil has sparked alarm within Trump's inner circle, with sources indicating frantic discussions about reversing tariffs to stabilize the bond market. Here's a gripping hook: what happens when a president's flagship policy not only fails but threatens to tank the economy he vowed to protect? From a Marxist perspective, Trump's missteps reveal the contradictions of capitalist bravado. His tariffs, rooted in a nationalist agenda, assumed the U.S. could dictate terms to a globalized economy without repercussions. Yet China's response, leveraging its $3.2 trillion in foreign exchange reserves, including significant treasury holdings, demonstrates the limits of American hubris. Beijing's actions are not impulsive. They're a calculated escalation in a financial Cold War, with analysts noting China's ability to absorb short-term losses far better than the U.S. due to its state-directed economy. Reports suggest Trump's team is now exploring tariff rollbacks, a tacit admission of failure as stock markets waver and consumer prices rise due to higher import costs. Could this be the moment when America's economic swagger crumbles under the weight of its own policies? The broader implications are stark. The tariff-driven trade war has not only accelerated China's pivot to gold and alternative currencies, but also eroded global confidence in U.S. financial leadership. As Treasury yields climb, mortgage rates near 7%, and corporate borrowing costs soar, the U.S. faces a potential recessionary spiral. Trump's rhetoric, accusing China of weaponizing its bond holdings, masks his administration's role in provoking this crisis. The panic is evident in closed-door meetings where advisors grapple with the reality that China's bond dumps could push yields higher still, threatening everything from housing affordability to corporate profits. This is no mere policy hiccup. It's a structural failure, exposing an empire reliant on foreign capital now facing a creditor unwilling to play along. As China asserts its economic sovereignty, the U.S. is left reeling, with Trump's gamble revealing a harsh truth in the game of global finance. America's moves are no longer calling the shots. The accelerating global shift away from the U.S. dollar, propelled by China's strategic sell off of U.S. Treasuries and the BRICS coalition's push for alternative financial systems, marks a pivotal challenge to America's economic dominance in 2025. As faith in the dollar wanes, central banks worldwide, led by China and Russia, are amassing gold reserves and promoting non-dollar trade, signaling a tectonic move toward a multipolar economic order. China's gold holdings have surged to 235 tons by late 2023, with its share of reserves reaching 4.9%, the highest since 2015, while its Treasury holdings have plummeted to $759 billion, a 16-year low. Imagine this: a world where the dollar, once commanding 88% of global foreign exchange transactions, is sidelined as nations like India and Brazil settle trade in yuan or local currencies. What happens when the greenback, the linchpin of global finance, is no longer the default? This shift is not speculative, it's measurable and deliberate. China's divestment of $8.2 billion in U.S. Treasuries in April 2025, a response to Trump's 145% tariffs on Chinese goods, has fueled a broader de-dollarization trend. The BRICS bloc, representing over 40% of global GDP, is actively developing alternatives, with China's yuan now accounting for 56% of its cross-border transactions, up from 20% a decade ago. Central banks are diversifying reserves, with global gold purchases reaching record levels, 137 tons in 2024 alone, led by China and India. Forecast project gold prices could hit $5,000 per ounce by mid-2026, reflecting a crisis of confidence in dollar-based assets. Here's a provocative hook: if the dollar share of global reserves, already down to 57% from 71% in 2000, drops another 10%, could we see a financial earthquake that reshapes global trade? From a Marxist perspective, this trend exposes the fragility of U.S. imperialism, a system built on exploiting global trust in its currency. The dollar's dominance has allowed America to borrow cheaply, funding wars and deficits while exporting inflation. But as BRICS nations challenge this hegemony, redirecting trade through platforms like the New Development Bank, the U.S. faces a reckoning. Russia's shift to yuan-based oil sales and India's rupee trade deals with the UA underscore a world no longer beholden to Washington. The dollar's 10.8% plunge in 2025, coupled with surging demand for European bonds, German bond yields dropped to 2.34%, while U.S. yields hit 4.5%, signals investors seeking safer havens. Ask yourself this: when central banks hoard gold and shun treasuries, isn't it a vote of no confidence in America's economic model? The implications are profound. A weaker dollar raises U.S. import costs, fueling inflation already at 2.3% in May 2025, while making American exports cheaper but less competitive in a world pivoting to alternative currencies. China's state-directed economy, insulated by capital controls, can weather these shifts, while the U.S., tethered to market volatility, faces rising borrowing costs and potential credit downgrades. The BRICS push for a gold-backed trade system threatens to further erode the dollar's role, with analysts warning of a dollar-apocalypse if de-dollarization accelerates. This is not just a financial pivot, it's a geopolitical realignment, where America's unipolar dominance fades as emerging powers assert economic sovereignty, reshaping the global order with every ounce of gold and every yuan-denominated trade deal. The dramatic sell-off of U.S. Treasuries by China in 2025, coupled with the dollar's 10.8% plunge, lays bare the inherent contradictions of American capitalism, a system buckling under its own weight as it grapples with unsustainable debt and geopolitical overreach. From a Marxist lens, this crisis is not an anomaly, but the inevitable outcome of a model that thrives on exploitation and endless expansion, now facing a reckoning as global confidence in the dollar erodes. China's strategic divestment, reducing its treasury holdings to a 16-year low of $759 billion, exposes the fragility of a U.S. economy addicted to borrowing, $36.522 trillion in national debt and counting. Picture this: an empire that prints money to sustain its dominance, only to find its creditors, led by China's state-directed economy, rewriting the rules of global finance. What happens when the world's largest debtor can no longer dictate terms to its lenders? This unraveling stems from capitalism's core contradiction. The pursuit of profit through debt-fueled growth creates vulnerabilities that external powers can exploit. The U.S. has long relied on its status as the world's reserve currency to borrow cheaply, funding military adventures and corporate bailouts while exporting inflation. But China's calculated response to Trump's 145% tariffs, dumping $8.2 billion in treasuries in April 2025 alone, has driven yields to 4.5%, raising borrowing costs and signaling a crisis of confidence. Here's a jolting hook: if global investors abandon treasuries, could the U.S. face a debt spiral where interest payments alone consume 20% of federal revenue by 2030? This isn't speculation, it's a trajectory rooted in the U.S.-owned fiscal recklessness, with deficits projected to hit $2.9 trillion in 2025. China's state-directed economy, by contrast, showcases a resilience that exposes America's weaknesses. Beijing's ability to absorb short-term losses, redirect reserves to gold S2 235 tons by 2023, and promote the yuan in 56% of its trade transactions highlights a strategic agility the U.S. lacks. While America's capitalist system prioritizes shareholder value and market signals, China's centralized planning allows it to navigate global headwinds, from tariffs to currency wars, with a focus on long-term sovereignty. The BRICS coalition's push for de-dollarization, including gold-backed trade systems, further undermines the U.S. financial hegemony. Ask yourself this: when nations like Russia and India bypass the dollar for oil and trade, isn't that a direct challenge to the capitalist order that America has championed for decades? The fallout from these contradictions is already reshaping the U.S. economy. Rising yields choke consumer spending, mortgage rates near 7% are freezing the housing market, while corporate debt faces refinancing pressures that could trigger defaults. From a Marxist perspective, this crisis reveals a system where wealth concentrates among elites while workers bear the burden of austerity and inflation, now at 2.3% and climbing. China's ascent, bolstered by its ability to prioritize state interests over market volatility, contrasts starkly with America's flailing response, marked by Trump's panicked tariff reversals and accusations of Chinese weaponization. This is more than a financial hiccup, it's a structural failure, exposing an empire crumbling under its own excesses. As the dollar weakens and global power shifts, the U.S. faces a stark choice: cling to a failing capitalist model or confront the need for systemic change, where democratic control of resources could replace profit-driven chaos.